Good morning, afternoon, and evening traders from around the world. I hope you've all had a fantastic week so far in the previous week 6, and you're ready to rock and roll into the current week of week 7. First things first, we need to take a look at the big things going on this week. Make sure that we know that, what news is going on, holidays, anything like that that might throw us some curveballs. So looking at the holidays, obviously, you'll notice today is Tuesday at the time of recording this, and that's because Monday was President's Day. It's a holiday. Markets are closed. We are opening back up on Tuesday and ready to rock and roll for the rest of the week. So it's a little bit of a funky one this time around, but overall, now that that's out of the way, pretty straightforward. As far as other news or holidays or anything like that, we don't have anything until May, so there's not really much else to worry about there. Looking at the news calendar for the week, we can see that earlier in the week, we don't have anything. Obviously, Monday, bank holiday, but Tuesday, we don't have anything today. Wednesday, we've got a little bit. We've got 8:30 news of the core retail sales. It's the only big news this week. And then at 2 p.m., we have the FOMC meeting minutes. On Thursday, we have 8:30 medium news with the unemployment claims and Philly Fed manufacturing indexes. And then at 11 o'clock, because Monday is a holiday, crude oil inventories gets pushed from Wednesday over to Thursday, and that will be at 11 instead. And then we've got Friday medium news with the flash manufacturing PMI. That's really about it. So the news calendar is kind of light, kind of quiet, and we only really have big news so far on Wednesday. And up until that point, it's going to be, it's not a whole lot going on. So with that out of the way, now we can start digging into some charts for week 7 between February 14 and February 20. First up on the list is going to be the NASDAQ, and with the NASDAQ, saying it's overextended to the upside would be an understatement. We are bouncing off of major objective highs for a while now, and just kind of bouncing off the top of the channel. And this channel is sort of formed in a multi-stage period where we've got this bottom of the channel coming across, which was confirmed, and then going back and taking that same line on the highs that obviously points to a channel high. But we've got some weird anomalies inside of here, like the break above, and then there's a miss down here, then it kind of missed here. So we needed a bit more clarity. And once it started showing a potential of a doubled up channel, then that gave us a pretty straightforward clue, and now we are seeing response to the highs. So even though the market isn't really pulling back, we can very obviously see there's an aggressive ascending wedge to the upside, and it's right at the top of the wider channel. This is definitely, once again, and I feel like I say this every week lately because every time it goes back up to the highs, but it's waiting for a pullback again. Realistically, buyers have had a pullback right at the, what was that? Right at the end of January, beginning of February. So that was a nice dip down to the channel lows. Buyers were able to accumulate, but since then, it's just nothing's happening. And usually when that's the case, when the market's getting really, really constricted, you can see every time that happens previously where it gets really constricted and then it stops being really constricted. We get really constricted, goes sideways, and then goes crazy. Same thing here where we've got these really nice constriction and then the market goes nuts. If we go to where we are now, this thing's been constricting forever. We had a nice little constriction inside here, breakout move, constriction, breakout, kind of, I guess, but now we're constricting again, and it's right at the top of the channel. Tough spot. Over on the S&P, we have a very similar situation, but instead of a channel, it's more of a megaphone. Kind of. It's not the best looking megaphone in the world by any means. It's basically a channel, but if you go far enough out, it does end up being a megaphone. Either way, we've got buyers that are defending the lows pretty nicely, and there are a few, again, anomalies that would, and kind of led me to believe that there's more of a megaphone here than a channel, because we've got these misses down here, miss there, and a lot of times that would allude to there being some form of a midline. But then when you take that same channel and you put it on the top, nothing really else lines up. So with that being the case, there's a potential of there being a megaphone inside here from the narrower high and the higher high. Either one is giving us a potential. So that's going to be kind of the zone of interest to see where they want to go. And it's all landing on right about the exact same spot. It's kind of in this pocket of interest. So where it stands now, the S&P is getting very overextended again. I feel like I say that about all the indexes, like I just said, but it's just one of those things where it's back up to the highs. You got a V bottom, rolled all the way back up to the top, and it's pinging off to the top of the megaphone, top of the channel, whatever you want to call this, and it's constricting very, very tightly. We need to see that expansion move next. Next up, we've got gold, and with gold, the big thing that's going on here is how sideways this is. It had an attempted gap to the upside, which looked like it was going to really start screaming away, and then they just got obliterated all the way down. Filled the gap in really quickly, dove down further, tried putting in a base of support down here, and so far, I mean, realistically, it hasn't failed. It hasn't done very well, but it hasn't failed. Failure would be a breach of the lows, and so far, the buyers have defended off of that. We do have a 3-press low, which is coming into play, and buyers have been defending with divergence the whole way up. So we are showing some signs of potential bullishness, but obviously the big thing here is that the falling resistance is just starting to break, and the last time it tried, didn't exactly do too well. If we narrow down to maybe some of the lower highs, you could see from an algorithmic standpoint, maybe this little inside high might make some sense, and the market's responding to it. So we've still got some work to do for the bulls to take over. And then there's crude oil, taking notes from Bitcoin, I guess. Rocket ship to the upside, finally breaking above the $60 mark. We got above 60, finally. It's also at the top of the channel. There's a lot of major objectives that are being completed on this move higher. We've been looking for the continuation up through, if you remember, this really nasty area inside here around 50 to 54. Got nasty, choppy, sloppy earlier ahead of that at around the 48s, and now we've got a really strong breakout move. But the concern is this is a really strong breakout move, and that's great. But why is it showing up so late in the trend? This trend has been going on for a long time. This is the kind of thing that you want to see at the beginning of a trend, which, if you are an aggressive bull, might be a pretty good sign. This might be the beginning of a new aggressive trend to the upside. But the problem is, when I see this kind of movement after a trend has been established for so long, my first thought is exhaustion. They're running out of steam. There's not enough to keep it going. Not enough fuel to the fire, I was going to say, but we're talking crude oil here, so it doesn't really work. There's plenty of fuel to go around. The problem is we've overextended above the highs, and we're not really seeing that follow through. So if the buyers can't stick the landing up here and maintain support above 60, that's likely where we'll see that dip back towards the 55s, 56s to fill in a bit more better support down in, I guess, what you could consider more fair value. Over on the euro, we have a very nice descending wedge, which is breaking out above and continuing back up. Along with that, we did have not necessarily divergence. I mean, kind of. If you zoomed in close enough, there is. But this is another one of those that just eyeing it looks like we've got a double bottom. And that is drastic enough of a difference from what actually happened to be considered divergence. Good enough. Now, that doesn't necessarily mean that we need to immediately be a buyer, but that means that the underflow, the guiding flow of the river, if you will, is beginning to shift. It's hitting an embankment and it's starting to turn. So is it turning right this second? Maybe, but it's not typically going to turn way the heck up here. This is very far up, and usually what you'll end up seeing is something like this, where it tries to get the move going, it does get a successful first breakout, and then pulls back, congests for a little while, and then gets the larger move. Right now, we have that initial breakout, which is still kind of succeeding, but you can see it's running into steam, running out of steam, rather. And now from here, we're going a bit more consolidated around this 21.5, 21.600 area. So given this kind of repetitive nature of what we're seeing, it would make more sense for a larger dip down that would allow earlier sellers who are potentially trapped to get out of break even, and it would allow dip buyers to be able to buy in and start pumping the market back up off of a retest of the wedge. All of the assumptions would be essentially buying with the really not wanting to see the failure of the lows in terms of a reversal pattern. And that's just mainly because it's still kind of early. Once we start seeing those higher highs, higher lows, really start breaking above some of these previous major swings, then we can maybe rock and roll. Then we've got Bitcoin over on the cryptocurrency side of things, and with a very nice breakout to the upside. Looking at more continuation up in 50,000 is not too far. It is right around the corner, and if we zoom in a little bit further here, you can see, there it is, right there. So if you're looking for a psychological level of support resistance, actually, did that candle hit it? 49,900, of course. You got to get that 49.99.99 deal in there. But we're right there at that 50,000 mark, and that's going to be a major psychological level. Whenever we're dealing with psychological levels, the response to them is key, right? Look back at what happened to 20,000. 20,000 was a no-joke level. The last time the market tried attempting 20,000, it made it up to one of those 19,999 kind of things, and then collapsed all the way down to 6,000. So the fact that we're hitting 49.9, that's not giving me the warm fuzzies. What we need to see here is more continuation to the upside. And if you'll notice, marking that line on 20,000, when it broke out, it didn't just kind of poke its head above the highs. It elbowed that thing in the face and kicked it into the dirt. Like, that 20,000's gone. And that's a very important factor given that amount of strength. Now we're coming up on 50,000. What's going to be the response here? We're going 20 now into the 50s. All of the buyers who were buying at 20, we had that 40,000 resistance, right? But the last time when it approached it, it didn't necessarily pause ahead of it. It hit it and then backed off. This time, we're pausing ahead of it. So they're going to have to break out if they're going to keep this thing going. And then finally over on Ethereum, which is forming a very nice ascending continuation, and not just an ascending continuation in the larger sense, but also in the smaller sense. We have a very nice ascending channel / wedge, whatever you want to call it up here, which is also forming in the nearer term, supporting the market. Which is really good for bulls because buyers know that they're able to buy inside of here. And even if it does break, they've just got more support underneath them. That creates this mentality of not necessarily invulnerability, but it buffs up the ego a little bit. And a lot of times when you have that, one of two things is going to happen. It's either going to stay aggressive and ramp up because the ego's so high and it just explodes through the top, or the ego quickly gets deflated and we see a big washout move, which dives back down and takes out some of these previous swings. Usually, if that's going to be the case, it's going to take out the previous major swings and dive in between the previous two. So if you look at the last major obvious ones right here and here, it wouldn't be a surprise to see a quick dive down inside of there and then continue back up, kind of juke everybody out of the move. Either way, it's very extended to the upside. We're butting heads against 1,800, 2,000, big psychological level is kind of right above our heads. Just need to go a little bit further. All right, well, that's going to do it for this week. Like we always say, stay safe out there, keep those stops in play, and let the winners run. I hope you have a fantastic week of trading, and we will see you all next week. Thanks.